have to just sit there for a while and wait until that nice fish comes along. Hi guys, thank you so much for joining me in another video. Welcome to my channel if this is the first time that you're visiting. Today I want to talk about where do we find long-term growth in the markets right now. It's all gone a bit crazy. If you haven't already, please feel free to subscribe, like if you like what you're seeing, hit that thumbs up for the algo. But yeah, let's just get into this. With all that's going on with the pandemic at the moment in the markets, it's hard to take stock of where to look for long-term growth in your investments. There are record levels of debt and unemployment, and with the government schemes that are helping people to just stay afloat, it's really difficult not to be sensationalist about long-term growth and long-term growth of the economy. And it's at this exact moment where retail investors tend to sell up and just miss the boat when it comes to economic recovery. And it's those professional investors that will reap all the rewards, if you like. And those professional investors can adjust their expectations using complex models and automatic trading systems at the flick of a switch, literally. One thing we should take note of is that we are not in a depression. Let's just put that out there. I think there's a lot of scare stories to scare normal people like us to think that we're in a depression or a depression is coming or we should all panic buy a pasta or something. No, we are not in a depression, guys. The government at the moment are able to provide a fiscal stimulus. Our industries are functioning completely fine. Energy is heating your homes or cooling your homes if you're lucky enough to live in the sunny parts of the world. Back when it was at the actual depression, you didn't get any of these things. So with that in mind, how do we take sensible stock of the economy and keep in mind those noteworthy areas that we should actually divert our attention to? In generally, if you are an investor, it's a good idea to kind of know where the heat will come from in the market, even if you are majority passive like me. So let's sprinkle a few facts out there and see what the situation actually is. Well, the pandemic and the virus generally has cast a spotlight on the healthcare and associated industry. If you've been watching my videos from the beginning, you'll remember about a stock I talked about called Moderna Inc., where the stock jumped 26% at the news of a positive coronavirus response to one of their testing methods. And then all of a sudden, when the markets realised that it was based on only 8 patients, it just dropped like no man's business. In any case, that does make healthcare a very interesting market segment to look at. Another point to note, which has always been on the horizon, is the rise of the middle class economies. And that in turn has had a huge impact on healthcare as well, with a growing segment of the population now being able to afford better levels of healthcare. So, by the by, where do we look for healthy growth in the economy? Well, obviously in healthcare, right? Ta-ding! See what I did there? No, let's ignore that. The healthcare industry is so broad that it suits every kind of investor. It has those large cap multinational companies that are well established, operating research and development across life sciences, diagnostics and medical technologies that we haven't even seen before. There are also a full range of stocks when it comes to quality super stocks, high-flying growth stocks and even the defensive picks. With the pandemic, there is just so much value even for the long-term investor. The holy grail for investors is to find companies that are compounders, those that deliver year-on-year earnings and growth. And that's how we can screen companies, eliminate stocks and also compare with these metric plateaus that are in place. And that's a perfectly good strategy for managing a portfolio of stocks with large caps mainly. So this next part of the video is a little bit more focused on the UK stock market. I have said in a previous video how people investing in the UK, like myself, are overexposed to the UK market, and all of a sudden if we have like a Brexit situation, we are super exposed with all of our investments. We work in our home country, we buy in our home country, we invest in our home country, we live in our home country. Everything is quite concentrated, so we're super overexposed when it comes to any change in the actual economy of your home country. That is known as home bias. There is a contrary belief to this, and that is called the Zulu principle. So the legendary investor Jim Slater coined the Zulu principle, and all it is a set of rules that will identify potential growth stocks. However, in this situation, you're using the principle to take advantage of your home country and your home situation. Personally, I have most of my investments in global index funds, and they tend to correlate quite closely to the major global markets. Then I do have a small chunk of 10 to 15 small caps. What about GSK? So with all of that jargon out of the way, let's focus on where we see that growth and return. Well, if you look at the solid UK blue chip companies like GSK, for example, GlaxoSmithKline. It's a highly defensive stock, low leverage, strong margins, great cash flow, consistent revenue. I could actually just go on and on and on. It has a dividend yield of about 5%, an F-score which is about 7, and a beta of 0.64. Now, it sounds like a no-brainer, right? And they have honoured their investors and haven't cut their dividends for over 20 years. Can you imagine, with all the turmoil in the market, they've stood strong. Having said all of that, there are also opportunities in the market when it comes to large cap. Yes, I said it. Corrections do tend to overshoot in both directions, but the positive is it creates buying opportunities at a low price. Where growth investors typically look for opportunities out of large caps, a correction allows us to look again at those companies according to their share price growth. And GSK has grown over 15% in 5 years. But that sounds okay, but if you turn around and just look over your shoulder at AstraZeneca, they have exploded. The stock has doubled in 5 years to become the most valuable company on the FTSE by market cap, compensating investors quite handsomely, if I say so myself. So there you have it, 2 large cap companies in the healthcare sector, one focusing purely on share price growth and the other one focusing on a steady, stable dividend. There are plenty of examples across large, mid and small caps just like these. What makes this segment interesting is the macro indicators like we discussed previously. Once you have a nice macro backdrop, it's almost just like fishing. You have to just sit there for a while and wait until that nice fish comes along. But always keep in mind what drives great companies, what makes a good company, and have your checklists in place and have your rules in place. That's all that matters. From my perspective, solid fundamentals all the way, no trends, no dramas, no hype. Just keep investing according to your rules and your macros. But until next time, please like, comment, subscribe down below if you haven't already, and I'll see you in the next one. Cheers, bye.